What's up, everyone? It's Karthik with MoneyVest. So with markets yet another 1% day on the NASDAQ and well within striking distance of all-time highs, gold hitting new all-time highs, an interest rate cut from the ECB, the producer price index numbers coming out, and the market's now shifting the focus very much to our very own FOMC going into next week. We got lots to unpack in this market update, so make sure that you drop a like. Do me a favor, let's see if we can get to at least 1,000 likes on this video. So do me a favor, drop a like, subscribe to the channel if you haven't already, and also share this video with your friends, family, other traders, and investors that can benefit from this update and our community as well. Link's going to be down below if you want to join and, of course, access all the members-only updates, including our Discord. I posted this brand new update on the options portfolio just 3 hours ago, so I sent out this update for all the members. You can watch this video, pretty much take a look at what I'm doing with my options portfolio, what kind of trades I'm taking, and how much of a return I'm able to generate on this portfolio. So again, link's going to be down below. Would love to have you on board. And there's something interesting happened with this as well, because Charles Schwab did really screw me over on this trade. So all of that was discussed in that video as well. So NASDAQ here pushing up a little bit over 1%, back up to over 17,500. The S&P 500 just over 75 basis points, and the Dow Jones up over 235 points on the day. So a little bit of tech rotation, and the risk-on rally continues in the market as we are seeing a lot of momentum over on technology, and more specifically, the Magnificent 7 stocks. So if you come over to our very own MoneyVest platform, this is a brand new feature that we are testing out right now. So it's still under internal beta. But you'll notice that the market cap change of $438 billion added in the S&P 500, of which the big three, so those are the Apple, Microsoft, and NVDA, accounts for over 18.6% of the S&P 500, or just under $10 trillion in market cap, added just under $87 billion here, because Apple really just struggled a little bit, and just under 1%. And if you account for the entire Magnificent 7, so the top 7 Magnificent 7 stocks here, almost $200 billion change, and that is just over 1.2%, and that of course makes up for 30% of the entire index. And now if you include for Eli Lilly, Broadcom, and Berkshire Hathaway, just over 35% of the overall S&P 500, just over $18.4 trillion of the $51 trillion that's the S&P 500, we're looking at just over $250 billion, or 1.5% on the day here in terms of that market cap contribution in the S&P 500. So some of the big winners here, of course, NVIDIA leading the charge after yesterday's big rally as well, up almost 2%, so $55 billion here. Alphabet, $44 billion. Google, $42 billion, so that's the two different classes. Meta Platforms, $36 billion. We got Microsoft, just under $30 billion. Broadcom, just under $30 billion. Amazon, over $26 billion. So a lot of these companies increasing several $billion in terms of that market cap as the tech rotation continues into the market here. So this is a very, very risk-on trade in the markets, and of course Apple only 1.6 billion because it was essentially flat on the day here. Now, ones that were down, Moderna was on the news. Enphase also selling off 647 million, and Moderna losing out on $3.77 billion here. I just want to confirm Enphase was indeed down that much here. So yes, that's definitely selling off quite aggressively, down over 4.3% on the day, and of course selling off over $648 million. And financial sector obviously has been under a lot of pressure. Charles Schwab was down $3 billion, rightly so, because they've been giving me a lot of trouble as I have the options portfolio on their account. And we got Wells Fargo here also dropping over 4%, down about $7.5 billion on the day as well. Now, coming over to the economic calendar. By the way, Adobe reported earnings, $5.4 billion in revenue, $4.65 in earnings per share. But coming over to the economic calendar, this is also something that we have built on the platform. Of course, inflation numbers came out yesterday, and PPI numbers came out today. You can also filter this by medium or high or low impact into the market. And if you take a look at yesterday's numbers, as we already know, the actual inflation rate came in at 2.5% headline on a year-over-year basis, month-over-month 0.2% in line with consensus, and core inflation 3.2%. And this right here was the big number, core inflation month over month, coming in slightly better than what the expectations were. In other words, slightly hotter than what the consensus was of 0.2%, came in at 0.3%. But today also we had the PPI numbers, which is also going to be in the medium impact here. So core producer prices month over month coming in at 0.3%. So once again, slightly hotter than what the expectations were. Very similar to what we witnessed for CPI yesterday. And headline inflation month over month coming in at 0.2%. I think estimates were 0.2% also. And then if you come over to the low impact item here, so which is going to be the year over year change coming in at 1.7%, slightly better than what the expectations were. Excluding for food, energy, and trade services, 0.3%. However, if you come over to the core PPI on a X food, energy, and trade services on a year-over-year basis, that was sitting at 3.3%, which obviously was a little bit higher. There we go. So this is where we are. PPI X food, energy, trade services year-over-year sitting at 3.3%, which was slightly higher than the previous number of 3.2%, which is what we have seen for 2 consecutive months. So inflation, is more stagnating sideways, I believe. It is, yes, it's trending lower on some instances. So we are seeing, headline inflation come down, but on a core basis, it is, when you exclude for and strip out for food and energy, it is more stagnating sideways. It's essentially just going a little bit sideways than anything else. And then if you come over to the market snapshot, this is where we are for individual indices and for stocks as well. S&P 500 is well within 2% of its all-time high, so we are in a dip. NASDAQ still in a pullback, down about almost 6% from all-time highs, and the Dow Jones is less than 1.5% from its all-time highs, with individual stocks here. Apple in a pullback, Amazon in still in a pullback, Netflix is down over 3.4%. You got Microsoft still in a pullback, NVDA still in a correction, although this recovery has been very strong. We were in a bear market at one point, and NVIDIA is exactly the stock I've been trading for the last 3 weeks here. Google here down almost 20%, although the recovery today was very strong, up I think over 2% on the day. Advanced Micro Devices down over 33% in a bear market. Then of course Oracle hitting a new all-time high. After hours, it's also up over 6%. Adobe's down 9% after the earnings, and Salesforce down over 20%. Meta is in a dip, down over 3.4%, and Tesla is 44% lower still from its all-time highs in a bear market as well. So those right there are some of the things that I wanted to break down from our very own MoneyVest platform. Now coming over to some of the more important updates, European Central Bank cutting interest rates again, another 25 basis point cut from ECB. And that again is putting a lot of pressure on the FOMC. And you'll notice that the CME FedWatch tool actually shifted a little bit more towards a 50 basis point cut. So if you come over to the probabilities, by the way, we've got the next Fed meeting in about 5 days. So 5 days, 20 hours. So September 18th is when the next Fed meeting is. And this is by far going to be the most important event for the market. I kid you not. This is a beginning of a new rate cutting cycle. Every single pivot from the Federal Reserve should be taken seriously, whether they're raising interest rates or cutting interest rates. But the difference is that the market is once again going to be uncertain about how many rate cuts and how quickly are we going to see those rate cuts. So every time the Federal Reserve is in a hiking or a cutting cycle, the markets are going to be uncertain, because the last 2 years, essentially 18 to 22 months, we didn't really see any changes on interest rates from the Federal Reserve. We've kind of been here for a really long time. So if you essentially open up the federal funds rate, so Fed funds rate, according to Fred here, and you open up this chart, you'll see that we have been here at this rate at 5.25%, 5.5% for a really long time. So last time the Federal Reserve ended up raising interest rates was back in July, August of 2023, and now we're doing this in September of 2024. So it's been well over 12 months that we have stayed at these interest rates for the US, right? So interest rate cut is a big policy shift, and now the markets are going to be in a guessing game. How much is the Federal Reserve going to cut? And whether that's going to be accompanied with a recession or not, and more importantly, whether that is going to be accompanied with a reacceleration on inflation or not. Because if you come over to BLS, if you take a look at where inflation is right now, so on the consumer price index, if you come over to charts, and then take a look at the last 20 years worth of inflation, this is not including for 1970s, but we are trending lower, so that's good. We are coming down, from highs of 3.5% back in March. We're now down to 2.5%, so that is trending in the right direction. And there's a lot of analysts that are also suggesting that inflation is going to undershoot the Fed's target of below 2%. However, this is not the all items CPI that I'm concerned about, because energy is doing its part. It's really energy that's kind of driving inflation lower, because it's now in deflation. Once again, it's down 4% year over year. It's really all items less food and energy. So it's core CPI that I'm really concerned about. It's more or less stagnating sideways, because we're still at 3.3, 3.2%, which is, again, you can arguably say that it's still well above the Fed's target. And then if you come take a look at PPI as well, so if you come over to the same website, go over to producer price index, go over to charts. And if you take a look at this number right here, which is 12-month year-over-year change, and once again, what do we have here? If you exclude for energy, which is the red line, I don't want to look at that total number. I really want to look at that total less food, energy, and even trade services for that matter. So what you'll see is, again, a little bit more stagnating sideways, well over 3%. So we're 3.2, 3.3%. So, there's a lot of people saying that, okay, inflation is coming down, it's trending lower, it can undershoot the Fed's target below 2%. So the Federal Reserve needs to start cutting rates now. 50 basis points. Some people even saying, the Fed needs to cut interest rates too much too fast because the economy is going to worsen very quickly. That may be true, but we also do not want to lose policy so quickly that it actually sparks the acceleration in inflation once again. Because the last thing we want is something like an episode of 1970s, right? So inflation from the 1970s, what you'll notice is this is not the price that I wanted to show you. Let me just go over to year over year and see if that comes up here. All items CPI. Nope, this is not the number. Let me just pull it up here very quickly because I do have that in one of these screenshots. So just give me 1 second. Boom, boom, boom. So this right here is the number that we were talking about. And this is, CPI kind of following a very similar trajectory to where we were back in 1970s, right? So this is what I highlighted in one of my previous videos, that if you compare inflation to now, where it was in the 1970s, we saw a huge spike in inflation. Of course, the numbers are a little bit different because back then we were well over 12%. This time around, we went up to over 9% for CPI. And as interest rates went up, we peaked out at those levels, and then we came crashing down for both in the 1970s and in 2020s as well. And now this is where we are. This is where we have kind of bottomed out. Now, the trajectory that we really need to understand is as interest rates get cut, right? That's where the focus is for next week. 25 basis points pretty much priced in at this point. As interest rates come down, is inflation going to, after the interest rate cut, going to see a trajectory that looks something like this? That it slowly and steadily makes its way down to 2%? Or is it going to look something very similar to the 1970s where it reaccelerates back up and really starts going crazy again? Because the Federal Reserve, what they're trying to do is find the right balance, right? Find the right balance between a policy stance that is not too restrictive, that it hurts the economy, but it's also not too loose, that it accelerates inflation back up. So hope that makes sense, because when people say that interest rates need to get cut down to like 1% or 2%, they really don't understand how monetary policy works. I mean, this is interest rates staying where they are. They're doing their objective. That's why they're higher, to bring inflation down. But at the same time, you don't want interest rates too low, right? Because that is going to create this environment again where people start borrowing. There's cheap money out there. The cost of borrowing is going to be really, really low, and then inflation starts to accelerate back up. So we really want to find a middle ground where the policy stance is not too restrictive yet not too loose at the same time, and it's moderate, where inflation is trending down to 2%, perhaps even lower, and the economy is also stimulated. There's still growth in the economy. Unemployment continues to be relatively low at under 4%. And companies are still hiring, companies are still spending, they're still investing. There's still the functioning economy with no weakness, with no recession fears, while inflation continues to trend down. So that's really the objective of the Federal Reserve. Now, of course, time will tell whether we hit that objective or not, but that's really what I wanted to convey in this video, where we are seeing the European Central Bank, of course, cutting interest rates for 2 consecutive meetings in a row, and the next week's main focus is going to be on the Federal Reserve. Now, 25 basis points, there is a 65% probability, but there's also now a 35% probability that the Federal Reserve goes through with a 50 basis point cut. So that's going to be considered as a bit of a jumbo cut here, or essentially 2 rate cuts in one cut from the Federal Reserve, bringing rates down to under 5%. And now the markets are fully priced in for at least 200 plus basis point cuts in the next 12 to 18 months. So going to as far as September of 2025, so 12 months out, the markets are fully pricing in for, I believe, so let's see, 1, then we've got 2 here, so that's 3, 4, 5, 6, 7, 8, 9, 10. So pretty much 10 basis points worth of cuts. That's about 250 basis points that the Federal Reserve is expected to cut according to the market. So if there's any variation from what the Federal Reserve does versus what the market's expecting, that's opening us up to a huge disappointment. And that, of course, will not be well received by the market. So I think that's really important to also recognize. Gold also hitting its new all-time highs as the Federal Reserve rate cut hopes bolster the appeal. So I mentioned this in our Discord. It's kind of flying a little bit under the radar, but gold here getting up to over $2,556 per ounce. definitely is a huge milestone for gold overall, because if you come over to the chart, we are looking at gold at well over 25.58. So huge rally, hitting new all-time highs. So that is very, very good to see right now for gold. Now coming over to some of the other things that I wanted to also break down here. Let me just see if I can open it up on this chart. So this is going to be the first thing, which is going to be the volatility. Now, VIX in election years usually peaks in October. There's a 63% chance of all the instances going back as far as 1928. So in the last almost 100 years worth of analysis of all the election years that we have looked at in this study, this is again not my study, but the research study here, between August and October, volatility has peaked 63% of the times in October. So the market has formed a low 46% of the times in August, right? So the month that just ended, August 5th, you could say that was the market low. However, the volatility does not peak until October. Now, you may be wondering that, how is that possible if the volatility peaks in October, August, how is that the market low? Well, the way they calculate this number is essentially based on the closing prices for volatility. And as we know that while August was a huge spike in the VIX at 65, it did not close at 65. It ended up crashing down to 30s by the time the day ended. And of course, it's come down to now 17s, right? So it's been cut in half and then cut in half again between August 5th and where we are now. So there's possibility that we do see some higher readings and some closing prices on volatility a little bit higher in October. And the market may have already bottomed. Of course, time will tell. I'm not here to call the bottom here, but just be aware that as the VIX does spike, or if it does spike in the future, that's only going to create better and better opportunities for us to not only buy into some of the higher quality assets, some of the higher quality companies, and dollar cost average into those, but also, look at trading the wheel, trading the options into the market as well. Okay, now before we come into the technical analysis, I do want to break down some of the charts here, of course, the MoneyVest index. And really what's interesting right now is the fact that the technical dashboard is so green. So this right here is the technical dashboard. We are green across the board, folks. I mean, Google is the only stock that is still struggling right now, as it has been fighting that battle, the legal battle with the DOJ. So that's the only stock that is struggling on the 9, the 21, 50, 100, and 200 SMA. Apple is also struggling a little bit on shorter, medium-term time frames here below those moving averages, but everything else. I mean, if you take a look at Magnificent 7 here, back above those moving averages. NVDA is back above all its moving averages. There's strong momentum coming in across the board for Amazon, Tesla, Microsoft, Meta. Now, they may still be down, in double digits in a correction or a pullback, but technically speaking, the momentum is back up as they are gaining a lot of ground on the technical front, back above their 5, 9, 21, 50, 100, and 200 simple moving average. Now, looking at the markets here, a lot of green, as you can see, that we are very, very nicely up. S&P, NASDAQ, and the Dow Jones. So all three indices are back above those moving averages. Russell 2000 still struggling on a short-term basis, still below the 5, 9, and 21 SMA. The dollar index definitely struggling a lot, right? So definitely below all of its moving averages, which is in part showing some strength for equities. Financials continue to be under a lot of pressure, and energy, as oil prices continue to sell off, we are seeing some pressure for energy as well. So financial and energy are two sectors that are still lacking momentum, but everything else, as you can see, is green. So we are seeing a lot of momentum and outperformance from all parts of the market, except for, of course, financials, energy, small caps struggling a little bit, as well as the dollar index, which has been selling off as well. Now, the MoneyVest index is back over 3.75. Volatility is down to 17, so we are back under the 47 percentile. We've got, again, 67%, 69% of stocks trading back above their moving averages, more than half trading back above their 20 simple moving average, only down 1% from its all-time highs. Put-call ratio is back closer to 1, and the RSI reading is back over 56 as well. So this is, again, a little bit more of a neutral slash slightly unfavorable market as it continues to move higher. As I mentioned this time and time again, the market's moving up is unfavorable from a risk-reward standpoint. If it goes down, that's good. If it goes up, that's not good from a buyer standpoint. The risk-reward is the best when markets are down. The risk-reward is the worst when the markets are up. So really in this market, you want to sit back, take advantage of those gains that you're seeing in the markets, because every day the market pushes higher. Of course, as long-term investors, we are going to benefit from that rally, but that also means that we have to be very careful, because this is not the time where I would be deploying a lot of capital. I would just much rather sit back, enjoy some of those gains in the market as well. So that's pretty much it for the macros and fundamentals. Now coming over to the technical analysis, S&P 500 seeing an incredible rally from those lows from back on September 11th. It's up a little bit over 3.5% from its higher lows. And if you come over to the 30-minute time frame, you'll notice that we broke out of this resistance. We were talking about this during our live stream, and this right here will go ahead and turn this level back into a support for S&P 500, and the next target is going to be 5640, and we are also well within the striking distance of all-time highs of 5670. So we are again just over 1.3% away from all-time highs, and this right here is going to be that support level to watch, and the resistance all the way up to 5640 now for S&P 500. Now what's also interesting is that if you come over to this chart on the S&P on the 4-hour time frame, there's two different ascending triangles that I really want to show you. If you have a longer term sort of steepening higher low here, what you have is that this pattern kind of coils in right around that election date. This is actually not a coincidence, because if you take a look at this being the first higher low, this being the high, and then markets selling off here, kind of overshooting a little bit to the downside, and then coming back up, making another double top here, and then formulating a very nice higher low. So if you essentially just follow the path for the market, going up and going down and going up and going down and kind of following into this ascending triangle, we kind of coil in right around that level where the election outcome is going to be announced, right? So November 5th and also November 7th, right? So that's 5 and 7, which is the election and the FOMC meeting. So FOMC meeting is going to be on November 7th. So those 2 days, that's where S&P kind of coils into this ascending triangle, which at which point it kind of feels like Judgment Day, where it breaks out or breaks down quite heavily. Again, I might be reading a little bit too much into it. We'll find out over time if that is the pattern that the S&P is kind of following through. But I thought it was interesting that we are making some type of an ascending triangle, because there is a double top here for the markets that we got rejected at a couple times already. And there's also very good higher lows that the markets are forming, right? So there's definitely an ascending triangle, which is usually a bullish pattern, because there is definitely strength coming in from the buyers putting in a higher low. But the bears are also doing their job, kind of keeping us below that double top resistance. So eventually what we want to see is a strong breakout, coming back down to retest, and then of course making our way back up to potentially getting up to over 6,000 on the S&P. So that would be the longer term sort of expectation from the market. And NASDAQ here is a little bit different. However, it did not make a double top. It wasn't like a horizontal high. It is still well within the lower high and lower low pattern. So, you can make a case that this is a lower high, lower low, and it continues to sort of trade in this pattern. However, we just made a higher low. So that is definitely something that is definitely a good positive sign, optimistic sign from the markets. And the next resistance that it needs to take out right now is going to be sitting roughly at 17,980. So call it 18,000 to round things up a little bit. And that will be the target that the NASDAQ needs to take out. So breakout here, coming back down to retest, and then potentially back up to testing all-time highs here at over 18,670. So that would be the trajectory for the NASDAQ. And QQQ is coming over here. Also got a little bit of a breakout above this 468. And we're now coming up to this next resistance at 477. That on the NASDAQ is also going to be this level right here at around 17,980. So call it around 18,000 for the NASDAQ composite. So that's going to be just over 2.3%. And this level is also, I believe, going to be 2.3%. So over 1.2%, 1.3%. So I guess that's going to be 487 if you are considering on the NASDAQ 100. So yeah, just a little bit over 3%. That's going to be all the way up to 485. But we also do have a little bit of an intermediate resistance here on the 30-minute time frame on the QQQs. That's going to be sitting right about there at 477. Now coming over to volatility, continues to slide lower and lower. So we are seeing VIX getting crushed back down from its highs of 23. It's back down to just low 17s, and it's down a little bit over 28%. Again, we're watching levels closer to 15, down to as much as 12. The lower the volatility goes, the more cautious and the more alert we need to be from a buying perspective, from a risk reward standpoint as well. And crude oil here continues to slide lower on the daily time frame, getting a little bit of a support from $66 a barrel and bouncing off of that support. And this right here is going to be turned into a resistance now for crude oil at roughly $73, $74 per barrel for this commodity. Now coming over to individual stocks, starting with Apple here on the daily time frame. So Apple basically flat after hours, a little bit more on the weaker side, but this right here is going to be that support level inside this green rectangle, resistance all the way up to as much as $236 for Apple. Very strong supports in roughly at 217. Talking about Amazon, pushing higher very nicely up over 1.3%. Resistance and targets all the way up to $189, close to $190 for Amazon. And support level is going to be staying put down to 181, down to as low as $173 for Amazon. It's really just been consolidating sideways for a really long time, like a really, really long time. Because if you essentially go over to where Amazon is versus where it was back in 2021, perhaps even before that in 2020, so September 2020, 4 years ago, had you bought Amazon, your gain would have been a very nice 6%. And up until a few days ago, it would have been nothing, right? It would have been really just been flat. And for the most part, you would have spent your time being down 53% on Amazon. So really, I mean, it's a company that has really consolidated sideways since 2020, basically. It's not really gone anywhere. I think it's really important for us to also look at these companies from a longer time frame as well. 4 years, 5 years out. Yes, long term, it's got great potential, no doubt. But last 4 years, none of this has been realized yet, that it hasn't really gone anywhere. Now comes to Tesla. Tesla also one of those companies that has not really gone anywhere since January of 2020. You can make a case for December 2020 as well, because it is essentially flat at the end of the day. And at one point when it was trading down to 142, it was coming back to its levels from back in August of 2020. So again, well over 4 years, and Tesla practically did not have any gains, but it had very good tradable opportunities from a swing trading perspective as well as options perspective. But for the most part, didn't really do much over the last 3 to 4 years. But nonetheless, this right here is the technical breakdown where, if you come take a look at more shorter time frames, we've got a resistance coming up at $233. So this right here is going to be that level to watch, with a support down to as much as $225 to as much as $208 per share for Tesla. All the way up to this lower high. And of course, we got a huge wall of supply for Tesla sitting roughly at 267 moving forward as well. Talking about NVIDIA with a huge breakout. Once again, back above 118 now. 118 was a huge area of resistance. I rolled out my contracts on NVIDIA. I shared all the updates in the Discord and of course in our options portfolio updates as well. And this right here is going to be turned into a support now for NVIDIA. But we'll see what happens next week with the FOMC meeting as well. And the next target is going to be back up to $139 to as much as $140 for NVIDIA, with a very, very strong support to roughly at $96 per share. Talking about advanced micro devices, and AMD here also moving up. Support level is going to stay put at 142. Resistance all the way up to $162 for advanced micro devices. Still well within the context of a lower high and a lower low pattern for advanced micro devices. PayPal, on the other hand, very nice move to the upside. So seeing some buyers stepping in at that support here, sitting roughly at $68 per share. And the target, or the resistance, I should say, sitting roughly at around $74, all the way up to $76, $77 per share for PayPal. And PayPal also has pretty much been dead money for a very, very long time, since 2018 actually. So it's been well over 6 years that PayPal has not really done anything for us. Now coming over to Visa, and Visa also has been a very strong stock with a huge breakout from its lows of about $255 back up to almost $290. Support level is going to stay put at $282. Resistance all the way up to $291 for Visa. Enphase definitely was very weak on the day, so selling off here quite aggressively, down about 4%. And for the most part, it's really just been consolidating sideways in that range for a really long time, and support level is going to stay put at $94, $95, and resistance all the way up to as much as $124. That's exactly where we got rejected more recently, before, of course, selling off and coming back down, and we got a huge area of demand, support sitting roughly at $92, $93. Costco, on the other hand, also moving higher, huge breakout to the upside, 1.6%, and coming up to its target and resistance, and pretty much the all-time high at almost $920 for Costco right now. And then finally, if you come over to Meta platforms, Meta has been consolidating sideways with a very nice move to the upside, up over 2.6%. Got a resistance and a huge area of demand, sitting roughly at $416, $420, and a huge area of supply and resistance sitting roughly at $540 for Meta. Netflix also pushing higher, up over 78 basis points. Resistance going to stay put at $700. Support level at $661 for Netflix. And right now, just consolidating sideways, well within the context of an uptrend, very, very well. And Google here with a very nice move to the upside, up over 2.2%, one of the big leaders on the day on Max 7. So Meta pushing up 2.6, Google up 2.2. And this right here, as we identified and pointed out, very, very strong area of support for Google. That was an area of demand, and the buyers did indeed step in after, of course, the bear flag breakdown that we identified in our previous updates as well. The next resistance is going to be all the way up to $163, $168 for Google. And finally, we come over to Microsoft, and Microsoft here also pushing higher, up almost 1%. And next resistance and target is going to be all the way up to $431 with a very strong support sitting roughly at $399, close to $400 per share. So hope you all enjoy this video and a complete update on the markets. The bottom line is tech trade seems to be back on. There is a risk on rally here in the markets. S&P within striking distance of all-time highs. NASDAQ also well within about 6% of all-time highs. A lot of Magnificent 7 stocks, once again, starting to lead this market higher. We'll continue to monitor how the risk reward kind of plays out in the market with the MoneyVest Index, the dashboard, the technical dashboard, as well as volatility, and a lot of other metrics that we track on a regular basis. And of course, don't forget, next week, we've got the big FOMC meeting coming up as well. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like and subscribe to the channel. Again, links to our Discord and Patreon is going to be down below. Happy investing. I'll see you all in the next video.